Hey traders! For this lesson, we're going to briefly go over conventional chart indicators and why we personally don't rely on these for our trading. We're also going to identify the difference between market data and market indicators. First off, we will identify the differences between market data and indicators. Market data is data that is supplied from the market, with the two biggest pieces of market data being price and volume. This information is raw data that is displayed on a chart. Indicators, however, manipulate this market data to derive a separate chart which is unique to that indicator. For example, Bollinger Bands, which are a common indicator, utilize standard deviations and manipulate price to form these bands. Our trading method simply relies on market data. We only watch price and volume. We do not utilize any conventional sorts of indicators because we realize that these are simply a manipulation of price data, and therefore any information these indicators may try to convey can simply be seen by spending some time and understanding price. Another reason we do not use conventional indicators in our trading is because they are primarily lagging indicators. What this means is that the indicator's information or data is changing until the end of the candle. This means that the information conveyed in these indicators is already old information by the time it populates. The only type of conventional indicator that can be a good representation of price movement is the moving average. This is because the moving average is different from most other conventional indicators because it is simply a line drawn on a chart that is the average of whatever period is specified. For example, on this chart, we're going to apply a 50, 20, and 10 period moving average. We can see here that these averages are simply the average price over this interval. Our reason for not utilizing moving averages is because we feel they are not necessary. Once you spend enough time with price and start to get a feel for it, the information conveyed in moving averages becomes apparent without even having them on the charts. Lastly, I'm going to touch on over-analysis paralysis. This occurs when our charts are so bogged down with indicators that we miss our trades. I used to personally be a victim of this illness, although luckily I have found a cure: spending time with price and volume. You see, when we have too many indicators on our charts, our minds are processing all this information and we become overwhelmed by everything. This causes us to miss trades that we should enter because we're busy analyzing all our different indicators instead of focusing on entering a trade. Take a look at this chart, for example, which is bogged down by indicators. Can anyone identify key support and resistance levels? I know that I sure can't. Now, if we take a look at the same chart without any indicators, look how clear the support and resistance levels are. That was a brief overview on conventional indicators and market data, as well as why we personally do not utilize them in our trading. I'm a firm believer that price and volume are the only pieces of information required to become an extraordinary trader. Sometimes keeping it simple is the best way to trade. Our next lesson is going to touch the tip of the iceberg on support and resistance and explain some of the basics behind it. Until then, good luck with your trading.